And we're live, and we're joined, Benny and I, by none other than Russell Clark, Mr. Brumby Capital himself, the Aussie in the UK versus the POM in the Oz. Welcome to the show, Russell.
Hi, thanks for having me. It's a great pleasure.
So, Russell, let's get to the point. You're a legendary short seller. Are we back? Are the markets there for us now?
Yeah, it's a good, it's a good question. I'd certainly think after a long period where shorting was tricky, I certainly think from what I see, short selling's looking more successful, if that makes sense. And it's more the other thing. Whenever I talk about short selling to people, is there are various ways to make short money from short selling. Uh, it's buying a stock that collapses. That's always great, like an Enron or something like that. But one of the biggest overlooked aspects of short selling, particularly for I think for professional investors, is the carry proceeds. So when you short a stock, you get cash, and that cash can generate interest. And now, because we have exited the era of zero or negative interest rates, you actually generate that cash as well. So short selling does look more interesting. I think the biggest change, I would say for me, and this is relating to US markets, which is the markets we still mainly only care about, is that the attitude of I think both Biden and the second Trump presidency towards corporates is a little bit more is less accommodating than it used to be. I think in line probably with the voting people of America. So you are starting to see sort of antitrust. You are starting to see some sort of regulation come in, which is not always supportive of big corporates, and so that's making it a far more interesting than it was, for a long period. Say from 2016 through a couple of years ago, where basically just big caps just always went up. I think we're now in a period where things look interesting, and also technological change is really hurting some of the larger stocks in the US market. So it is a period that looks interesting to me. Certainly, I'm finding it interesting.
So, I mean, what evidence are you seeing really of the DTC having some teeth? I mean, I saw a lot of talk on that front, but what's really pressing corporate power right now?
So with short selling, if once it's become apparent, then it's never a good short anymore. But the one thing I found very encouraging is, uh, and this is also looking at sort of market action, is like so I think the DOJ is looking at Visa, Mastercard, and looking at sort of the payment structure there, which has always been a source of cartel like behavior. And certainly in Australia and other markets have always tried to do something about it, not very successfully.
Well, they just
One of
announced
the
something this
interesting
week, actually. The point of sale charges in Australia just became the RBA announced that this week, which is a pretty big deal, actually, because normally they'd be terrified of Visa's lobbyists.
Exactly, and the states has done something similar. And the thing is, I have been bearish with these stocks for a while, partly because what we saw with Bitcoin blockchain is offering an alternative technology, not necessarily adopted, but it's alternative. And what we've also seen is, particularly in China, the creation of alternative payment forms to Visa and Mastercard. They've been quite successful. They also are less profitable because they don't take as much money from the retailer. And normally, when I'm sort of looking for shorts, as I've always tried to explain to people, the best shorts is not finding a bad company. The best shorts is finding a good company that's starting to see competition. We're seeing that with like the software as a service companies. Great companies, but suddenly they've got competition, and so their metrics are probably going to deteriorate, mainly because they're going to have to compete more. And those are the better shorts is when competition comes in, and that's why I think, particularly for US stocks, we're starting to see a bit more competition coming in everywhere. And you can see like previously untouchable shorts, companies like Microsoft, for example, starting to trade very weakly because people are starting to think about, well, are they going to be able to hold on to this sort of, corporate software monopoly they've had for decades now? And, I always wonder that. I always wonder, why do I have to keep paying for Excel, even though the technology, Excel never gets any better, and now they make me pay monthly. You know, will it happen? I don't know, but certainly Microsoft's spending money to try and stop, you know, to try and keep its monopoly, like all the big tech companies. So suddenly it's a much more interesting environment, I find, on the short side. Certainly, US markets have been far more beneficial for shorting in the last year than they have the 3 or 4 years before that.
It's funny you say that because here in LA, a lot of gas stations will have a cash price and a credit card price, like advertised on the board. So you're starting to see some of that where retailers are offering two prices, to get around that MasterCard. But the point taken on that, like where a great company turns into things change, like Bed Bath and Beyond back in the day, Eastman Kodak, recently Nike, Chipotle. Like they have their run, and then it kind of something happens, and then they're just kind of slow burn. So I guess as a short seller, is that what you prefer versus, hey, it happens all at once, now I got to find another trade? Or would you rather something that keeps paying you?
It's sometimes it really depends. Like the ones that keep paying are great because then you can reload because they'll always have a bounce, and then you short some more and they go down, and then you can generate a really chunky return on capital. That being said, a stock that falls like 9% a month is something you always remember as like a glorious sort of profitable trade. They don't
And it
happen. They
makes you
don't go
feel it
along
makes
too
you feel
often.
so smart too. It makes you
It
feel so
does.
smart.
It
That's
does.
the that,
But they
that
don't.
that is the siren song of short selling. Is you need to strip your ego out of it.
Yeah, well, look, the only ones that, historically speaking, for me, what I used to do, which was why I was able to short sell for a lot longer than most people, was that I used to use equity shorts to express currency positions. So if I thought the Brazilian real was going to fall, I'd go find European companies with big Brazilian real exposure and short them. And I found a much cheaper way to short Brazilian real that way than doing it directly. Um, I think I was going to say, Benny, I'm very intrigued that you said there's a cash and credit card price in the States. For a long time, that was banned. You weren't allowed to offer a cash discount. It's very common in Europe, particularly in like Germany and Holland, very common. But in the US, it was banned to offer a cash discount or a different price for cash on the back of Visa and Mastercard lobbying back in the day. So if that has come through, it may mean that legislation has changed as well. So I'm going to look into that.
Yeah, I mean, gas stations, you drive around and they have actual billboards. So it's not like you go in the store and, hey, you pay cash. You know how that goes, kind of bodega style. It's like actually on the boards now. And I don't know. I mean, it's those guys. It's a hard business to start with, retail, and the U.S. consumer. A lot of people are getting squeezed, so it makes sense. If you're not like a big airline mile person, it's a way to give a
Yeah,
little discount.
and they're taking what 2.5% out of the retailer on those credit cards. Right? It's a lot of money. Yeah, so change is coming. I mean, it's normally the way of short selling. Change takes much longer than you expect to turn up, and then when it does turn up, it happens quicker than you expect, which is really the awful thing about short selling. Is like you might wait on a short for 2 3 years, but then you make all your money in a month. But that's life.
It's a
Do
bit like,
you?
well, Ben manages a tail risk fund, and the worst thing about doing that is that your big day in the sun is the day that you have to give all your money back to your LPs.
Yeah, yeah, but you made the money and you hopefully get crystallized. Being crystallized at a good point in time is really the key to making money in the hedge fund industry. I think. Otherwise, just keep going until something goes
And
wrong.
and actually, that's a really good segue because you gave your money back. When was it? It was like 4 years ago now, first time round when you gave your money back.
Yeah,
And I'd love you to talk through that process because you're now up and running again and you've seen the shift. So walk me through the decision to go, okay, I'm not seeing the bull right now. Have your money back. I'm coming back at a different time.
So so when I first started, traveling and getting interested in the markets was like in the 90s. When I was a teenager, I went to Japan in 91. And then, I saw the decline in Japan. I was in Hong Kong in 98, saw the GFC. And then I started working for UBS in 2000, saw the dot-com bust. And then we had the sort of GFC after that. There was also a couple of emerging market crises in the early 2000s, the Argentinian devaluation, the Brazilian devaluation. And so what I learned through that sort of 15 to 20 year period was that there was always going to be a crisis somewhere. So you just need to look around for it and be positioned for it to try and make some money. And I think, as I sort of mentioned earlier, often the crisis was a sort of currency led, or currency movements could give you a bit of a tell on what was the problem. Currencies and bonds actually tended to be pretty good tell of something going wrong. So you ever saw like JGB yields start to fall again, you knew something was going wrong somewhere in the world. And so that was sort of the business model I built. And that really worked. I'll be honest, that worked great. It worked great for a very long time. And then in sort of 2015, it was sort of signaling we're coming to the end of the China story. It's a long time ago now, but China looked like it was going to go into a property crunch. Its currency looked overvalued. So I saw an Asian financial crisis all over again. And yet somehow when we got to 2016, everything changed. They closed their current account. They stimulated. There was no real negative effect. And then we had Trump go elected, and everything sort of turned. And it was the opposite of what I learned, which was basically, when market economics turns on you, it really turns, and there's nothing you can do about it. Whereas 2016 was more like, oh no, we can just choose not to have a crisis. It's no problem. And there's no negative to that. It was the opposite of everything I learned. So I sort of played with it for a bit. And then in 2021, I was still doing my macro analysis, this sort of stuff. And then in 2021, I was just reading the newspaper, and they were talking about how the Chinese regulator had set up all these digital regulatory authorities, and then called in every big Chinese tech company to have a chat.
Yeah.
And having dealt with China for a long time, I was like, God, that sounds terrible. And this is back in the day when everyone just said you buy big tech and don't think about it. So everyone was massively long, Tencent, Alibaba, and stuff. And it's just when Didi Xuxing was listing. So, I basically went short at every tech company that was in this meeting. It took me about an hour to find who was in this meeting, but I found it, went short on them. They all then fell 50% over the next year. But in my mind, I was thinking, well, if the tech companies in China go south, we're going to see that, derating of US tech. That was my thinking, sort of dot-com era type thinking of how stocks move together. And instead, what we got was US stocks went to highs as Chinese stocks went down, 40, 50%. And I sort of reflected on this and went, you know what, it's all just a political game now. It's a political game of Trump, and the US government is all behind US tech. The Chinese have gone a different route because they've got some sort of different political agenda. And then once I realized that, I sort of went, well, I'm a macro guy. I've always been a macro guy. I did my degree in economics and Asian studies. What do I know about politics? I didn't think I could credibly go into a meeting and say, the world's political, this is what's going to happen, with any authority. And so I decided to give money back and go have a think, write a Substack, basically sort of chronologically, basically logging my thoughts as they developed over time. And then, my first attempts at trying to monetize a political view on markets. And once I thought that started to get some traction, I relaunched Brumby Capital. And now, as I try and say to people, I am always politics first. The problem with politics is it gets tricky sometimes. Like, I didn't really see like this war in Iran taking place. I got the politics of that wrong, but now it's happened. I'm trying to think about how it resolves politically, um, which I think I've got right. But we'll talk about it another time, maybe. But yeah,
Well,
that's
actually,
been the process.
let's jump there because one of your sort of your key things to watch has been Israeli equities, and you know they have obviously been on a tear since the Hamas attacks back in October 23, and you know, listen, there's a bit of global beta here, but you've always said, Russell, that watch Tel Aviv equities to see how the war is going. Now, that doesn't look like I mean, that's a pretty good chart up until when the war started, in my view.
Oh well, that's only come off. In the last week or so.
The last
Um,
couple of weeks.
what I also found very intriguing about that. I mean, there's a lot of tech in Tel Aviv, tech and defense stocks, a few banks as well. But the other thing that I was looking at is the Israeli shekel, which has been very strong,
Yeah.
conspicuously strong in an era, in a period of a lot of dollar strength. And I really sort of felt like if the Iran war was going really wrong for Israel and the States, you wouldn't see that sort of strength. You certainly didn't see like the Ukrainian Harina. I can't say it's the
Hervina.
Ukrainian. That's the one. That didn't strengthen. I can tell you that until a good year or two into that war, if that makes sense.
Well,
Um,
neither did the ruble, really.
Ruble is very weird currency, but yeah, and it's a tricky one because the oil prices did skyrocket for a while,
Yeah.
but it is weakening now. As things have gone wrong. But you certainly favored Russia to win that war when it first started. Now they're sort of stuck with no exit strategy. But it's to me, if if it was really going wrong, you would think you know Israeli currency would see a lot more weakness. I'll be honest with you, and it doesn't look like that. I mean, if you look at the amount of money they've spent so far, it to me is, and this I think also is true in World War II, is that pound sterling I think started to rally around 1940 41 once they knew that Germany wouldn't be able to get into, wouldn't be able to cross the channel. People started buying that currency because they knew things weren't getting worse, which is getting better. That makes sense.
Yeah. So where do you think you are? I mean, you put out an interesting piece the other day about your sort of hostility towards the dumb Trump trade. Um, I thought you were almost guilty of sort of treading into sort of 5D chess territory in terms of the end game here with this war in Iran. I mean, my personal view is that I'm just literally fading every headline right now. All I want to know is the Strait of Hormuz open, and then we can think about risk again. But your take was interesting. Why don't you expand on that?
Well, the thing for me is, I think the headlines that people put out there is like this is going to be the '70s, the OPEC embargo era all over again. And I feel it's actually a very different setup. I think what we had was, and it's sort of in the '70s, this America, which was a dominant power back then as well, suddenly realized with OPEC and with Russia, and they were, I think, working together. We do have a weakness. We import oil from, and rely on oil, which is controlled by nations that are opposed to us. And I think what happened then was the US went, okay, there's nothing we can do about that oil thing. So we need to change ourselves. So that's why they got Volcker in. That's why I went for more austerity, what I've called a pro-capital type policy change, which really made oil usage much more efficient. And you saw after they went to that, oil prices collapsed, and eventually caused the collapse of the Soviet Union. But that energy weapon still was there. It just was less powerful until China came along and tightened the market up. I think what's happened now is, with shale oil and gas and also the rise of renewable energy everywhere, is that even though, yes, OPEC in the Middle East is a big center for oil and gas, there are alternatives out there. And actually, the reason why we've had the war of Russia and Ukraine, and now this war in the Middle East, is that behind the scenes there would have been some diplomacy about you shouldn't do this, and they're like, you need to give me that, you need to give me this and that, and at some point I think the Americans would say, well, what are you going to do if we don't give it to you? And they go, oh, we're gonna disrupt the energy markets, and they've gone, oh, go on then, do it. And they've done it. Russia cut off gas to Europe. Iran's now closed the Strait of Hormuz. You look at natural gas prices in the States, they're $2. They're $2, which is $20 equivalent oil. Why should the States care about it? They shouldn't. And actually, if you look, for me, what this is not the beginning of a new OPEC era. It's actually the death knell of the OPEC era. Because what's going to happen, to me, it seems obvious what's going to happen, is now everyone's going to put in a risk premium on Middle Eastern supply. And they're going to go, okay, we're going to build more renewable. We're going to buy more LNG from Australia rather than Qatar, for example. It doesn't have to go through the Strait of Hormuz. Politically, a much more stable region. And people are going to keep building the nuclear or do whatever.
As long as my heating bill's not indexed to the global LNG spot price, Russell, I don't care. I think we need to slightly rewrite that agreement in terms of sovereign resilience and energy security down here.
Yeah, that is a problem. But all I'm saying is that the reason we've suddenly started to see wars in these energy producing areas is because they don't matter as much as they do. Which is, I think, it's interesting. I think I find it really interesting. If you took that logic one step further, is as soon as China can develop a competing chip to TSMC, or can make semiconductors to TSMC standards, then they'll probably go and invade Taiwan, and no one will care. It's just, what I'm trying to say is that supply issue is a real constraint, but now that constraint's gone, the politics can now move into a sort of different era. And for the US as well, there are two big strategic wins from the closing of the Strait of Hormuz. One is everyone has to buy more US oil and gas, and the US now has lower cost energy than Europe or Japan. And secondly, Europe and Japan have to spend more on defense, because if they want to buy oil from the Middle East, they're going to have to protect it themselves. And these are two key objectives of the Trump administration. So, and also the final thing as well is when Iran does close the Strait of Hormuz, it's really actually just kind of supply to allies, China, India, So the longer it goes on, the worse it gets for them. I'm sure they're smart enough to realize that. That's why I think a deal will happen. But even with a deal, to me, it's the end of this era of the Middle East being the dominant supplier or even the swing supplier. And now they just have to take what the market gives them.
So what does that mean? Go on, Benny.
No, I was just going to say, because that's been my view as well, that this it benefits the U.S. at the expense of Europe, at the expense of Asia. And, everybody's always worried about that Taiwan invasion. And from what I understand, I'm not a military expert, is that the U.S. doesn't have anything they really could do about it if they did it. That maybe having the choke point in the Strait of Hormuz is just kind of a countermeasure, an energy countermeasure, if you will.
Yeah, I mean, I think the other way of thinking about it is if we had the energy, the oil and gas technology we have today, if we had that 100 years ago, we would not have built massive oil fields in the Middle East. If that makes sense. We would have said, we're going to rely on the US, because the US was the biggest oil producer for decades before its wells started to run dry, and then we moved to the rest of the world. And so it's just for me. So when we talk about politics, and I talk about politics, I think politics is often driven by technological change. So like the Trump presidency has really been driven by social media. Trump never looked great in newspapers or TV, but in social media, he looks fantastic, and he's got the right attitude for social media. He's constantly posting, he's constantly saying what people want to hear. He's a real social media president. You can see he runs the White House to suit social media. and that's because the technology has changed, and then the politics catches up to it. And I really see that and really believe it. I think that's where we are in the world. And this war in Iran, closing Australia for Hormuz, is a reflection of the reality is the US doesn't need that oil anymore and doesn't need that gas.
So, Russell, I mean, what does this mean for markets, though? I mean, and let's start with your lodestar, the GLD TLT trade. This is just the monthly GLD over TLT chart. Your one of your favorites.
Yeah. Well, that trade's made me a lot of money. I'll be as I've said to people, I'm somewhat naively, I assumed war in the Middle East would probably be good for gold and bad for treasuries. So naive. What was I thinking? I think in reality that trade moved a lot in the first couple of months, and I suspect it's just like the shock of change has forced a degrossing. But one thing that I think I've been saying this for the last few months is that when you look at the GLD TLT trade, and if you look at it in the long term, it went much, much higher back in the 70s, which is when we had a sort of crisis in US debt, if that makes sense. And I think for me, the end game of where we are now with current politics, the rise of populism, and is that governments will keep spending, to offset any problems. I expect governments to spend to offset this higher oil and gas prices, would be my guess. And so at some point, we are headed towards some sort of, I think, debt crisis, government debt crisis. You could argue that it's already happening with spiking gold prices. But,
This is just your 10-year yield.
Yeah. So I think it's going to tend. I mean, what I find most interesting, I say this is just me, is very esoteric, but for the longest time, Japanese banks just used to accumulate deposits all the time and didn't know what to do with the money. So they used to stick it in JGBs, and then that would force JGB yields down, and then they'd be looking for yield and go buy treasuries and other stuff. What's happening in Japan now is I think the Japanese are woken up to inflation, because there is a lot of inflation in Japan now. They're starting to take the money out of Japanese banks. So if you look at the banks that I look at, they tend to see falling deposits now. Now, if that happened in the States, those banks would probably be shorts, because without the deposits, like we saw with Silicon Valley Bank, without deposits, people freak out. But now we're starting to see the Japanese go, we're back in an inflationary environment. We need to take our money out of deposits and do something with it. And ultimately, I think that's going to push up the cost of capital globally, because the Japanese are the biggest savers in the world, in the international markets anyway. And again, a bit like GLD TLT, great run into the beginning of the year, a bit of a correction, but I think they still look very, very attractive.
So just let's stick on the Japanese banks for a second, because I'm long too and definitely focused. What you're saying about, I mean, one of the core pillars, at least for me, around the Japanese banks was just the strength of their deposit franchise, right? And the fact that they have been able to basically own deposits for free, and now they have a steep yield curve. It should be, money all the way to the bank. Forgive the pun. What you're saying about deposits is making me think a bit, right? So do you want to expand on that?
Yeah, well, the deposits are only falling slowly, like maybe 1-2% annually. But the loan deposit ratio in Japan was so high, it's not a problem yet. And the other thing to think about deposits, there's two different ways of thinking about deposits. For me, I like deposits. I think, a real value for a bank is not in its ability to lend money. Anyone can lend money. It's very easy to lend money. Getting it back's hard, but lending money is easy.
Private equity is learning that.
But, it's actually being able to attract deposits is very difficult. You need to be, very safe, perceived as a safe institution. Used to be you didn't need to have a big branch network. I'm not sure that's so true now. Now, it's probably true in Japan. It's still a very heavily cash-based society. They're changing. And so for me, while I look at banks, I look at them in this sort of rising yield, rising cost of capital world, I look at market cap deposits. This is not a metric I see anyone else use. It's just the way I like to think about it. So I'm like, how much market cap do I have to pay for $100 or 100 yen of deposit? And Japanese banks, even though they've rallied quite a long way, are still among some of the cheapest in the world. And my prediction is that the smaller regional banks, which I own a few of and are much cheaper, are probably going to get bought by larger banks as deposits become a little bit more scarce in the system, because they can take those deposits, strip out the costs, and then invest them into the JGB market. And for the big banks, this will become a very profitable trade at some point. And so that's why I like these smaller banks. They still trade below book, and 4 or 5% of deposits against, let's say, a typical American bank is around 20% of deposits, market cap deposits. So it still looks very attractive to me. And Japan is short in the history of the planet in 1994 when it was yielding 4%. And of course, it went to zero and went below that. And when I first started working in financial markets around 2000, I remember, I was trying to learn everything I could. And they would say things like, if governments run large deficits and central banks fund that through very low interest rates, you're going to get inflation and your market's going to blow up. And I was like, well, what about Japan? And they go, oh, Japan's exception. We ignore Japan. And I was like, does it make a lot of sense to ignore like the second largest economy in the world and the largest saving nations in the world to make your model make sense? There's also, the other thing about equities always go up. And you go, wait, well, Japan, the equity's done nothing now for like 15, 20 years. So, you got this nation that's defying all these rules you're telling me, and you don't have a good reason for explaining it. Can't we do better than this? And I sort of, my original sort of model for how the world worked and how I used to trade was based around this idea of Japan as a sort of Saudi Arabia savings, as money would flow out and flow in. But what I sort of realized over time now is more, I think Japan and the Japanese really accepted the sort of Washington consensus of free trade, free capital, don't control your currency, let everything be free. And all of those policies are very deflationary. And they were introduced after the inflationary 70s. And but the thing is, the Japanese just adopted them completely. And if you've ever spent time with Japanese, if they agree to something, then you're pretty sure they're going to do it. It's very different with Australians and Americans or Brits. We'll agree to it, but then if it stops making sense, we might go, let's have a talk about it. It's a different society. And I think what's happened first with Abe and now with Trump is they've gone, okay, the rules are not the rules anymore. We can do something different. And I think the JGB market is reacting to it. And the reason why it has such a sort of huge hold on me is, I think you asked me, why did I give money back in 2021? So I was short into COVID in 2020, and we were making so much money. I was long JGBs. I was short all these Chinese companies, short a lot of cyclicals. We were minting money, and then a strange thing happened in like April of that year, or March of April, and I was like, we're in COVID, people are dying. We still didn't know how many people were going to die. Everything to me seemed a super deflationary, super credit disaster event. And we still didn't know what this COVID was going to do. JGB yields started to sell off way before there was any clarity on what was going to happen with COVID. I found it really odd. I was like, what do the Japanese know that we don't know? And I think what they knew, and I always think Japanese are very smart people and very good investors, so I think they knew every government in the world was going to press the fiscal button, and the world had changed to a world of government spend to make things better, which is very inflationary. Now you can see, if you can see
Yeah,
the
I'm just
red
calling it up
line.
there. Yeah, they moved very early, didn't they?
They actually, what's even more amazing about them, in a way, is that they. You sure the timeline on that one's right? But they actually didn't hit. They didn't hit a new low during COVID. They went down and then rose before the above the lows that was set. Oh yeah, you can see it. If you look
Yeah, you
back
can
to
see it.
2016 when I owned them, I made a fortune in those. The yen went up, JGB yields collapsed, which was part of the model, and I made a fortune in them. And then COVID, I would have expected them to go even lower, and then actually they turned at a much higher rate than previously. Uh, and I was like, that is very strange. And you can see they foreshadowed what happened to the treasury market. They moved well before the
Yeah, well,
treasuries. Oh,
this
the
is
German
German
market,
yields.
but
Yeah,
yeah,
same
but
thing.
they moved well. Same thing. And I'm like, okay. And so as long as the Japanese bond market keeps doing that, it tells me we are not in the deflationary world that we existed in. And so you need to have a different model for how you make money. And so, when I look at shorts now, where I used to look at I used to use equities as like a arbitrage of currency risk. Now I look at equities as an arbitrage of yield risk, if that makes sense.
That's how the
So
market's been for a while, right? Like, I mean, we've seen since post COVID, you look at 22, right? The bond market got wrecked. Stock market went down some, but it didn't get hit that hard, right? And even let's just look at this. And look again, just so you know, Russell, I'm a bond bull, but I'm just speaking to that there has been a change. Last month, my rates got smashed. The S&P went down some, but it wasn't anything crazy, right? So I think there is something to be said that the correlation is positive again, and the bonds are getting hit harder in these events than the equities are actually.
yeah, I much prefer bonds. I think are still a short, but and I think the thing is like it's a sort of a mindset thing. Is now governments go, well, look, bond yields are only 4%, 5% or whatever, and that's a cheap source of borrowing. So they can keep borrowing from them and until the bond market gives up on it. It says no, we're not going to lend you any more money. Now, from my perspective, if you look at what gold is doing, you could already say there is a sort of crisis of confidence building in fixed income treasury markets because why is gold doing so well? As a lot of people have told me, a lot of people have asked me, normally much younger people, and more in their 20s, go, well, why do you own gold, Russell? Because treasuries pay a yield. And I said, well, and I say to them, they don't pay me enough yield. And they're like, but what do you mean? It's like the highest yields in like 20 years. I go, yeah, I'm thinking more like 980s type yield for me, please. And
It,
they're like, what do you mean, like 10%? I go, yeah, 10%. And they go, but it can't be 10% because I can't pay my mortgage at 10%. And I went, the market doesn't care if you can pay your mortgage or not. Anyway, that's the type of discussion I get, which stops me from being invited to parties these days.
but
Just gonna say
There you go.
that'll make you popular in the pub.
but
It does not make me popular in London, I can tell you that.
But ultimately, what you're saying, and I really did slam this home over the decade of like looking at cryptocurrencies where these guys would be like, oh, I got a 50% yield or a 40% yield because you're trying to attract people to hold your network token. And there's no difference of the South African real or the British real or whatever. Like, hey, we got to take rates up, the classic Latin American, not to pick on them, but let's say emerging market strategy. And now our friend David Dredge has talked about this global Hunger Games of capital, and the outer districts are going to have to raise rates in order to attract people to assets. So maybe the U.S. can get away with it, but everybody else, and you just saw it with Japan and Germany, which are basically District 2. And so that's kind of the dynamic that's been going on. I think you're right. I think ultimately, though, doesn't it become a deflationary bust if these things go too high, or do you think the government's just print infinitely to avoid that deathly scenario?
So again, you have to sort of delve into politics again, which most fund managers are unwilling to do. But I always find that you add value when you do what people don't want to do, if that makes sense.
Yeah.
And if you look back at I think the problem, the issue why it's so easy for me to think yields go higher and government spend is that populists, both on the left and the right, keep getting more and more votes. And neither populists on the left or the right are austerity-driven politicians, right? They are going to spend. And what you can see is then the center's reaction to that is, well, we need to spend, but we need to spend better than what these guys are going to spend. And that also sort of feeds into this. And why it's, for me, you buy bonds if you think unemployment in the US can go to 8 or 9%, right? Do you think you have a political environment where either party can tolerate, or accept an outcome where unemployment goes up? And in my view, because the politics has become so combative in the US and combative everywhere, to be honest, is that everyone in power is basically on, well, we will only stay in power if we keep unemployment low. Now, the big shift that happened, I think, in the 70s with Reagan and Thatcher is we can only stay in power if we get inflation down and we don't care about unemployment. And by then, of course, unions had gotten a bad name, and people were like, unemployment's gone up, but it's because the union's fault. They didn't blame the politicians. But if we look at the politics today, people are much more pro-union than they've ever been, in my life anyway. And that's why I think it's much more likelier that the governments just spend what they need to spend. And ultimately where we're going, I feel, is if you look at the current system, there will be forms of wealth tax coming in. And that's when the markets really tank. Once you give people an incentive not to buy back shares and push up valuations to 7-8 times sales, and they I think the first step will probably be more trying to equalize capital and wage income, the way they're taxed, which doesn't happen at the moment. It doesn't happen in the UK. Capital is taxed far less than wages. It's not really politically sustainable anymore. It's just difficult to implement. But eventually the bond market will force some sort of more tax raising regime onto capital. And it's already beginning. So for expensive London properties, you're going to see a surtax charge already added to them, like a management tax. That's happening. And I think you've seen in California, you got a billionaire tax coming through. So the changes are there. It'll just take a while. And my view is what's going to happen if we look back to the 70s is eventually too much is going to labor and the pool of capital available shrinks so much that we can't do the investing that we need. We get more and more inflation, and eventually the politics turns again. We go back to sort of deflationary trades. So, when I'm 70, I'll probably be telling all the kids to buy bonds, and they'll be like, we can't buy bonds, they only yield 10% and inflation's 15. You crazy, Dad. And I'll be, yeah, just buy bonds, don't worry, and don't sell them. Just run them to the end. Like buying bonds in 1979, 1980 made sense. And that's the bigger trade.
Sounds like Ben's dad.
My old man started at Merrill Lynch in like 81 or 80 or something, and he was buying bonds when no one wanted bonds, and he built his whole business off, owning that paper from back then. People were like, "Oh, this is great." It was a great bond run for sure.
Yeah, but if you looked at the politics, then you had Reagan coming in, going to break the labor market, the power of unions. You had Volcker. So Volcker, if you saw what gold prices were doing the last couple of years, interest rates in the States would already be 15%. Volcker saw gold price up 5%. He raised interest rates 2-3% because he recognized what that represented. We now have a different class of central banker. I'm not sure the class is the right word, but we have a different type of central banker these days.
So Russell, what is the one chart that you put on the wall of every central banker's office?
I don't know, man. No, I don't know. They're just I think it's just these guys just change with a lag. So they really all, to me, they all feel like yesterday's men. If that makes sense. You talk to them, they don't. They're just, they're trading on a past that doesn't exist anymore. Like I posted some Substack today, but in the last week, so I have a gardener that comes around once a week, and I've got like a cleaner comes around every 2 weeks. Both of them asked me for pay increases in the last week, and these guys are great guys. And for like 10 years, from like 2010 to 2020, they didn't ask for any pay increases. Gave them one in like 2020, 22. But then as soon as they saw the oil prices going up, they're both like, we know what's coming. I know what's coming. Every company is going to be raising prices. They were like, we need a pay increase. And I was like, I understand. And I'm like, when when the mindset of the worker has changed that much, interest rate, monetary policy needs to be tight. You need to have real rates of 3%, which in the UK is probably around 7 or 8, would be my guess. Same in the States. But they can't bring themselves to do it because they feel that would be too deflationary according to their models. But their models are based on a price that doesn't, a world that doesn't exist anymore. What is
Yeah.
this?
So listen, I've just put up the wheat price here because you've written a couple of times that food inflation is the only thing that really scares the crap out of them. Why? I mean, I listen. I've been long and wrong on the food inflation trade for several years as well. Why has that trade not worked yet? I'm still keeping a yield.
So I would never invest. I would never recommend investing in ags. It's a highly specialized area, and I've made a lot of money long and short commodities. I've made a lot of money long and short commodities. The big problem with ags is the supply. So if you analyze gold or iron ore, copper, rare earths, any of these things, supply is pretty much a fixed.
Yeah.
You can guess where supply might come from, but it doesn't change too much. I mean, you could get a first year graduate to work it out, and they're not going to go too wrong. But when it comes to like ags, you're really like playing dice with God here because the weather improves. They have a great a couple of weeks of sunny weather in Brazil. You suddenly have oversupply, and you cannot get out of that position. It's going to be limit down 7% every day for like a month until you can even potentially sell a scrap of your long position. So never deal with ags directly. I've tried a few times doing other trades. It just doesn't work. I don't.
Yeah, I guess my point
One of
was
those
more
things.
about my point was more around food inflation. We see inflation everywhere, but why not in food? And it's as simple as that. If wheat grows if you piss on it, is it as simple as that, or is it something else? And
Yeah,
ultimately, I kind of agree with you that food inflation is what really gives nightmares to central bankers.
I think the food that we buy it is influenced by the raw ag. If they go up enough, they'll rise as well. But generally speaking, a lot of the food prices that you eventually people consumers pay come from things like really from labor. And it sort of makes sense to me that the price you pay for food matches the price you pay for labor. So most of the cost of food is basically labor, and so why I think food inflation is going to come anyway is the price of labor is going to come, and at some point to break that cycle, you need to create deflationary environments in labor, which requires you to have really high unemployment. If that makes sense. Now, what we've seen is if we see energy prices go up or fertilizer prices go up, we're going to see a push in the food prices up a bit more. But then if we then get the wages coming through, that becomes like a cycle. And we've sort of seen that in Japan. Food and price in Japan went nowhere for 20 years, right? And then under Abe and with the sort of Russia-Ukraine war, we started to get a push higher in food prices. And then workers went, I need a pay increase. And when they got the pay increase, it actually fed back into higher food prices. And so now I think in a sort of inflationary cycle, which is why I think central bank policy now is very misguided, because I think the genie is out of the bottle. The genie that Volcker killed and Reagan killed of this sort of inflation cycle is actually starting again. And if we get a spike in wheat prices, which I think is very possible, we are going to see food prices move up again, and particularly very iconic food prices. Bread has always been a big problem. They call it a bread line for a reason. And typically the French get very upset if the croissant price rises above. It rose above €1 a little while ago. I did take a look. I think the thing in the UK, so it's the €1 espresso croissant in Europe, right? With Southern Europe, if that makes sense. In the UK, equivalent of that is the Tesco meal deal, which was £3 from like 2010 to 2020, is now up around £4, right?
What do you get
So you
what
got,
do you get for that £4 from a Tesco
I
meal
don't know.
deal?
I don't eat a Tesco meal deal. The sandwiches don't look very good.
Live stuff for short sellers. What are you talking about?
No, well, but I think, but if you talk to people, they get remarkably upset about price increase in the Tesco meal deal, or the Boots meal deal, or whatever you like. And I think these things are lost leaders. So when they push them up, what I find extraordinary is how expensive fast food is. So I do a lot of driving here and there, and we stop at like a KFC, and I'm like, it's not a cheap meal anymore, KFC, or McDonald's. And this I think is what drives food and wages, and when it has this circularity as wages go up, food prices go up. And the only way to stop it is to have real rates much higher. And again, this and price to income ratios on property will inform me that wages are going to go much higher, or interest rates have to go much higher, or probably a combination of both.
So, Russell, just in the last segment, I just want to talk about markets again, and equity markets specifically. And from where you started in terms of, well, this war in Iran may solve some longer term problems for America. Yet you clearly favor the ex-US equity trade, Japan in particular, versus US equities from here. Why don't you tie that together? And this is just the S&P versus the EFA on a daily chart. And well, I should say, sorry, the EFA versus the S&P. I usually show my chart of truth the other way around. I'm showing the ex-US in an uptrend here.
Yeah, so the way I understand the world, and the world that the Americans created after World War II, was basically said to like Japan and Germany, you guys can't have armies anymore. You outsource your security to us. We'll let you trade with us and build stuff. And I think from the 70s, that sort of transformed into, we also need you to buy our bonds and treasuries, which the Japanese did in gusto. Germans less so. But you've generally had this sort of deal where Americans provide security, and the Japanese and the Germans pay for it in a very simplified system. And now under President Trump, you basically have this, the deal is sort of being reneged. Is like, we're not going to provide you security anymore. You need to build your own security. Whether that is wise, I think history will judge. Having less armies in the world, particularly armies that can do stuff, and Japanese and German armies have proven they can do stuff. Having less armies in the world is probably a net positive, so we'll see what happens with that. And then you've got this added thing where US, with the war in Iran, has highlighted the energy deficiencies of Europe and Japan. So what I see now is that these nations that didn't follow the US on military spending are going to follow them, which means they're going to take their money and they're going to invest it domestically. And so if you look at a lot of the tech lead that the US has over its allies, a lot of it comes from, or starts out as, military R&D. which makes a lot of sense because when you do military R&D, you're not doing generic stuff. It's got to be cutting edge or nothing, right? You don't spend a lot of money on developing tank technology from 20 years ago. And so what it says to me is that what I feel is that the changes that Trump has wrought is actually going to be much more positive for Europe and Japan. They're going to get out of this sort of deflationary slump, and that's what the bond yields in these markets are telling you. They're going to be investing heavily. They're not going to be seeing they're saving money, and now they also have a model for how they can modernize their economies to be more like the US. So a lot more data centers, a lot more things like that. And so I find it really attractive. And the story I always tell when people ask why I'm particularly bullish on Japan is that TSMC is building a big fab down in Kumamoto, it's southern Japan, and they advertise in the local newspaper for cafeteria workers at the local Taiwanese rate, which is like $20 an hour. And all the articles in Japan were like, why are they hiring at 3 times the local rate? Which is about $7. And I feel when I look at the world as well, I feel like most big semiconductor companies don't want to invest more into Taiwan. They got enough Taiwan risk. If they're sensible, they probably think there is some unresolved military issues with Korea as well. I see that. And so if you want to do tech investing and have the tech expertise in place, the only country that's really left is Japan. And Japan's so cheap, obviously much cheaper than Taiwan wage-wise. So all of this makes me much more bullish on Japan, even with its energy problems at the moment, than anywhere else. And I feel like from 91 onwards, Japanese stopped investing in Japan, and now they're reinvesting. And it should be very bullish. And so far, the market has confirmed that view.
Perfect. Well, listen, Russell.
Let me ask you one last thing. When you think about structuring these things, right? So we're talking about at a high level. How do you go about structuring it? Plain vanilla? Do you use options? Do you use swaps? Like, what is kind of your timeline, and how do you carry it? Do you do negative care? You obviously do often if you're a short seller, but like, can you just talk a little bit to that, of like how you would like to express things?
Yeah, so I try not to take a direct view on markets too much. So I'm not going to say when I think Japan will do better than the States. It doesn't necessarily mean Japan goes up. It might mean the States goes down more and Japan does nothing. If that makes sense.
Mm-hmm.
So if you look at like the trade we talked earlier of long gold versus treasuries, what I'm sort of saying there is unless treasury yields are much, much higher, gold is going to do really well. That makes sense. So it's all these sort of relative trades, and they're all politically driven. So they're really, I want to hold them until I see the politics change one way or another. So the time frame is it could be forever. If you look at some countries like Turkey, for example, short Turkish lira has always been the right trade because the politics in Turkey never changes. And so this is how I sort of think about it. What I suspect, and it's sort of almost a Soros mentality, is at some point price action forces political change, and that's what you got to look for. Just like Volcker and Reagan were brought in because of inflation being out of control, that was a time to flip those positions. And just like Trump, the election of Trump and changes in Chinese policy is what drove a more inflationary world. That is what I'm looking for here. So everything I do is like a relative. I try to have a relatively low net, or even be net short, but a combination of assets I think are going to do relatively better. And for me, the big paydays, and one of the reasons I launched Brumby again, is if you understand everything I was saying, I think when I get very excited is days when treasuries sell off and gold goes up. And the only time we've really seen that recently was back during the Liberation Day tariff sell-off. I think that as soon as we saw Treasury sell off, Trump, scaled back the tariffs the very next day. But I think that ultimately is where we're going. Ultimately, there's going to be a real loss of faith in fixed income. I mean, I personally don't understand people's faith in bonds. I used to own a lot of bonds. I made a lot of money from bonds, but the world has changed and they're not attractive anymore. So that's how I sort of structure them, and then I basically that's the high level thing, and then the secondary thing is like when politics is, let's say, favorable. So, for example, before the Iran war, Trump was going around saying interest rates should be 0 or 2%, and the Fed's a useless institution. In the way I think about things, I should be making money on days like that. I don't know if that makes sense to you, but the politics is coming my way, so I should be making money. And if I'm not making money, I look at why I'm not making money, and I get rid of the trades that aren't working. It's nice to be intellectual, but I also, you got to make the sausage, and it's just reality. That's what you get paid for, is making sausages. And so if
you just don't want to watch the sausage being made.
Game, exactly, you don't want to see it. It's always ugly because people go, "Why did you sell that trade? It's part of your big theme." I went, "Because it wasn't making me sausages, and I had to get rid of it." That's
all right. The sausage factory.
People relate. It's everyone in every business. We all like to think it's all glory and we can all be pure, but you got to make money, and so I tell people what I'm going to do. There is an intellectual purity to what I apply. But it's more like, this trade makes money when it's supposed to make money. That's why I like it, not because intellectually it's pure, if that makes sense. And that's sort of how I work. I don't know if that makes sense or not, but it's trying to combine intellectuality with trading nous, if that's the right word for it.
Well, Russell, that's a perfect way to tie things up. Where can people find the sausage factory that is Brumby Capital? How do people get in touch with you?
Just go to the website, brumbycapital.com, and drop me a message there and I'll get back to you.
Now, people might not be Australian. They might not know how to spell Brumby. That's Brumby with a Y.
Brumby with a Y. A Brumby is a wild horse in Australia, and also the name of my local rugby union team.
Nice.
Which is why I quite like it. Wild and untamed, much like myself.
Russell, are you a big cricket fan like Rupert is as well?
I'm a very big cricket fan. I wrote on my Substack a big post about parents should be making their kids learn cricket because there's a huge mismatch in. So both my sons do competitive sport, and my youngest one was doing cricket. But the interest in cricket is relatively low relative to the amount of money you can now earn at the pinnacle of cricket.
Yeah.
If you're you can make a lot of money.
You get into the franchise cricket. Yeah.
If you're a serious athlete, you can go into cricket and get to a very good team very quickly, and they're going to be subsidizing you coming in. But no one wants to play it, and I don't know why. It's a great sport. It does require a lot of concentration. It's much harder than baseball. Much harder than baseball.
Yeah,
it's a different league than baseball.
That's a really
so funny, the arbitrage.
Tool.
Hang on, the arbitrage. I say that about.
Well, I'm always looking for arbitrages.
Well, no, but this is we are short particularly with Gen Z. We are short attention span. And cricket is a game that totally requires it. I actually, that's really, I want to think about that a bit more. This is extraordinary. Russell, thank you so much. I will catch up with you in London very shortly. Thank you for joining us. Benny, the squirrel, and Russell, thanks very much.
Thanks, guys. Thank you, Russell.